Good afternoon, everybody. It's welcome to Brown Janikowski's monthly market update webinar today, Tuesday, September the 28th. I know that we haven't done one since about the end of August, and a few things have happened since then, and quite a bit's actually happening today. So it's a good time for all of us to catch up. And if people have questions, because it seems like the last few meetings I've been sort of somewhat repeating myself, and things have been going fairly steady and without a lot of incident, but there's definitely more news in the market today than there was a month ago. So please feel free to barrel in those questions anytime. So as always with these things, when one puts the questions together, it seems very topical at the time, and sometimes a week later it can seem less topical. But I do think China is something which we're going to talk about today. In fact, we're going to talk about China, inflation, and the bond market mostly, but definitely China. But there's been a sort of a culmination of the events in China, which started with some months ago, actually last September, with the Ant Financial IPO, and it seems to have escalated since then. And more recently, we've been hearing about a company called Evergrande. So we'll cover that. Okay, let me jump straight in. So I put this slide together this morning just because those of you following the market will see that we've had I'm not going to say a correction, because technically a correction is down 10%. We're nowhere near that, but we are down about 2% on the S&P for the day. I mean, it's flat for the week, and the month is about 3.5%. So we've had some move backward from the highs in early September. So what we're seeing today is the market's down, bond yields up, and this is actually not so much the Treasury 10-year, which can move around quite a bit. Recently has been trading between about 150 and 120 and 150, and today is sort of up towards the higher end of that. But it's the short-term rates, because the 2-year Treasury has been like a flat line for pretty much since middle of last year, trading about 20 basis points. So just a fraction, a hair above the federal funds rate. But today, or the last few days, it moved up to about 30 basis points. So yeah, we've had about a 10 basis point move on the 2-year Treasury in the last few days. And I think what's happening there, and I'll kind of come on to it in a minute, is that it is reflecting the fact that the Fed has been talking about tightening. Now they're going to do it extremely slowly, but the 2-year is going to be the where it shows up. And up until now, it's been fairly benign, and everyone's sort of feeling that the rates will stay lower for longer. I still think they will, but the 2-year Treasury has finally sort of moved off its incredible lows. The other thing that we've seen is that the bonds in Europe are lower, and just in the last again a few days, we've seen German bunds go from negative 42 basis points. So again, just to remind you that the way that works is if you buy a 10-year German bund, you're going to be out 0.5% a year, when it matures. So you can be buying at a big premium and getting no coupon off it. But anyway, they moved from 42 basis points to 20. So that's a 20 basis point move, again, from incredibly low and negative rates. But it does indicate that there's some combination of inflation and growth prospects coming through in Europe, and not before time, I would add. And then on the gilt market, that's the UK bond market, similar thing. They've got their own problems with huge natural gas shortage right now. And the Bank of England announced that they think 4% inflation might appear over the next year or so, from much lower today, and those rates have moved from 70 to 90. So again, another 20 basis point hit in increase in the bond rate. So it's, before we were always talking about the US and everything else was just nothing happening, and now it's beginning to drift over into the major market economies, and I think for mostly benign reasons, in the sense of its better growth, but also an indication that inflation will be higher than what it's been, which wouldn't be hard given how low inflation has been. So I've kind of put this down as, okay, so what made the market move today? Obviously, whenever we do this, there's a little bit of hindsight and walking back and think, well, I think it's combination. No one actually ever comes out and said, well, I sold my stock today because, but I think it's this, that the energy issue in Europe has got a little hairy. I'll show you a graph in a minute, but this is a continent mostly which is using in the heating winter season natural gas, and natural gas spot prices have just taken off very, very fast. I also think that last week's message from the Federal Reserve, where essentially they talked about beginning tapering or announcing that they would do tapering in the October meeting, which means that they could actually start as early as late this year. But I think that message is kind of sinking in, that there's some change there. Not a big, huge change, not a 180 or anything else, but just kind of sinking in that, maybe this is going to be the end of the QE levels going along at $120 billion a month. US politics. I mean, clearly, we've all been reading the headlines on the reconciliation Infrastructure 1, Infrastructure 2 bill, the hard infrastructure, the soft infrastructure. Will the government shut down, and what's going to happen with the debt ceiling? Is it going to be suspended, or is it going to, be renewed? And obviously there's a standoff going there. And when you have people like Janet Yellen talking today that, hey guys, just to remind you, you really don't want to go up against a debt limit and have a possible default. The longer this goes on, then the more sort of nerve-wracking it becomes. I wrote about it in the blog last week. I don't think we'll be in a default status, just because we never have been before. And I think people tend to blink when they get that close to it, but definitely the political side, it looks pretty tied up, and no one really wants to play with one another right now. There is the technicals, the kind of grand sweep all of reason why markets go down, but there is a lot of money, trillions of dollars, which rebalances every quarter, either between stocks and bonds or different asset classes within that. And you do get these kind of moves up to the quarter end where there's a lot of option heading. There's a thing called gamma, which I won't bore you with it, but essentially means that if the market moves in a certain direction at a certain level, the option pricing goes faster and faster and faster. We saw it with things like GameStop in the other direction, but essentially, if things start moving too fast, then they tend to go faster in the same direction. I think some of that is happening as well. Supply, I have misspelled China there, but it's a China factory closures, there's still port delays, there's a semiconductor shortage, all these things are still out there. So there's a kind of a supply demand problem. Central banks are very good at demand problems. They can certainly sort of instigate higher demand in the economy, but they don't really deal with supply issues. There's really not a lot they can do. That tends to be more of a corporate business, logistics, transportation type of issue, and that's really what we've been facing, and that's really what's driving the inflation side. And then also finally today we saw a consumer confidence number, which the headline was, it's down, it's been the lowest since February, but it's still way up what it was, at its depths for most of 2020, and it's at levels that were at 2017, 2018, and before that, it's at higher levels than it was for the almost entire decade after 2008. So yeah, they're down, but they're certainly not, hitting low. And consumer confidence is very much, when you take those, whether it's this one is the I can't remember, I think it's the Chamber of Commerce. Anyway, it's not the University of Michigan one, which is a slightly better one. But people very much think about what's been happening today or the last few days, and if they feel less confident today, it's hardly surprising given what's going on with Delta and the politics side. Okay, that was just to kind of give an introduction of where we are today. I can't seem to get the next slide here. 1 second. Here we go. This is interesting. I'm going to just play you a few seconds of this because this is important.
The buildings were marked for demolition because the development could no longer meet market demand, and the long period of neglect had allowed rainwater to flood the foundations of the buildings, inflicting irreparable damage. The blast zone covered an estimated 500,000 square meters, which according to the Liberty Times.
All right, you get the picture. You can see that online if you like. But that is interesting because this ties back to Evergrande, and what those guys were doing there was demolishing that whole development of apartments that were never lived in. They were built, I don't know, 2009, 2010, 2011. They had specification problems. People couldn't ever move into them. The developer couldn't complete them. And they just kind of sat there in limbo with everybody pointing at each other saying, well, you haven't built them. He says, well, we haven't got enough money to finish them off. And so they reached a point where they were just structurally impaired and they blew them all up. So the reason I bring that up is that that is a very good symptom of what's going on in China. We've seen this remarkable story of the last year where, again, mentioning it, starting off with Ant Financial, which was a Jack Ma, Tencent, or Alibaba, I can't remember, spin-off of payments, sort of like a PayPal. And the Chinese government pulled it. Then recently they went after a ride-hailing company, Didi, which has actually got a partly owned by Uber, or the other way around. But anyway, but they went after those guys. They went after the entire industry of private tuition, $100 billion market. A lot of public companies were involved in that. They all, their share prices just completely vanished. And they've been under, the gambling, I think, is another one, and real estate. And so what's happened with real estate, that's not necessarily a bad thing, but I think Xi Jinping made a comment, I know it was rather recently, but people just kind of woke up to the fact that, property wasn't really for speculation, it was for living in. So so there was this, the government said to property companies, hey, you can only have these kind of leverage ratios. Evergrande, second biggest construction company in China, was way above those, financially stretched. It looks like they missed a coupon last year, last week. And now we're just kind of waiting to see how many people are in the lineup of creditors. But so that's a particular problem with a particular company, a particular industry. But it does point to the fact that in China, there is this GDP has been pushed along for years with big infrastructure projects. The 80% in the US, 80% of the GDP is the consumer. In China, it's, I don't know, 30, 40%. Investment in the US GDP is around about 10, 11, 12. In China, it's been 35%. As I mentioned in the blog, go out and build an airport or a bridge or a terminus, and that immediately has an effect on GDP, and a positive one. But if it doesn't have any kind of financial viability, it's going to sit empty. It's got an internal rate of return of close to zero. And eventually it's just going to show up as having to take a write-off against it, or just shows up as a massive waste of money. Same thing that happened with Japan when it tried to reinvigorate its economy in the early 90s with the famous bridges to nowhere. So there's a little bit of that going on with China, and it certainly showed up in the property market. And I think that's why, there's a concern that for large parts of the property market are way overbuilt and way over leveraged. There's 60 million, at least, some say as much as high as 90 million housing units unoccupied in China. You could fit the entire German and or French and or the UK population into them. So there is this feeling that the China GDP story is changing from this magic 7-8% compound growth, about to become bigger than the US, to something a little bit more disconcerting. And I think, for now, China's going to be on a much slower growth market, and certainly not the kind of economic threat that people think it is for the US. But the three big issues today is, Delta has peaked, but it certainly hit Q3 GDP. We now know that the Fed is going to, we now know that they are going to taper. How much they're going to taper will follow, but my guess is that they're doing $120 billion a month right now. They'll probably get it to zero within about 8 or 9 months. And essentially QA for this cycle, unless something terrible happens, will be over, and then we'll be into talking up rates. So really, we're looking at a late 2022 hike in rates. Inflation story about whether it's camp temporary or camp permanent it's kind of, most of the spike in inflation is fading a bit, but we're certainly in the camp of that it's mostly temporary. We've changed, before we were adamantly it is temporary, but there are some things that might say, well, it might level out a little bit higher than the 1.5% inflation which we had for the 10 years after the GFC, but it's definitely probably going to settle in a little bit higher than that. A big risk to the economy? Certainly not, but some adjustments going on where inflation is going to tick up. China threat to global GDP, I think that is now very much should be on everyone's minds. I mean, it's the second largest economy, and it's stuttering, even if they won't, actually reveal the real numbers. Debt ceiling, I put it as a short-term problem, but it's a bloody big problem. I mean, again, I don't think they'll go all the way. Someone will blink, but meanwhile, you've kind of got to look and stare down that abyss for the next, week or two. I think we can get to October the 18th, with the Treasury doing various clever things to try and avoid not having to default on a T-bill maturity or a coupon payment. It'll be the T-bills which will get hit, if anything. But again, I don't think that'll be a problem. Consumer confidence kind of all over the place recently, just because of the Delta and inflation and the jobs market not being as strong as it should be, but it's way up from 2017. I think it's a big thing to worry about. And the employment is, just steadily increasing. Now, a few months ago, we were much more bullish about the third quarter as well. That's when everything would be open. They'd be through the summer, and the jobs would be coming back. And but Delta came along, and kind of put that to bed. The benefits have ended, so they'll be likely. We'll get the first month where the benefits ended, i.e. September. We'll get the September unemployment numbers a week from Friday. So I would expect them to be better than the August numbers. They have a hard time not being better than the August numbers. So it's kind of like it's improving, but fairly slowly, and claims are also improving again, but fairly slowly. Let's remind ourselves, just this spike was pretty big, with Delta. Now it's off, but you can see how much bigger it was here than anywhere else. This is just the average new cases. I think if you do it by per 100,000 in the US, still doesn't show up very well. But it was a big deal to go from down here, 20,000 cases a day to suddenly we're back up to 140 and 150. So, you guys have been following this. I know, that it's been affected the vaccinated, unvaccinated people, and in certain states in particular. This is again kind of breaking it down by state, and there's some big improvements there. But look at Florida. I mean, it basically, they were much worse than they'd have ever been. I mean, here's good old California. We had our worst time late last year, and then had a spike and we're down again. But some of these guys, they got record numbers. So there's a big strain on the system. But I think from a purely economic point of view, it meant that people weren't going out as much, weren't spending as much, weren't prepared to socialize as much. And all of those industries which depend on that had a more stuttering recovery. Originally, the big expectation was that we'd see these explosive GDP numbers, 3 quarters at 6%. We're roughly back in GDP, actual nominal or real GDP in dollars, back to where we were, and slightly above actually. So from that, the US has done quite well. There's a lot of countries that are still below, especially in nominal terms, what their GDP peaked at 18 months ago. So we've done well there, but there was more expectation. The Fed had penciled in a 7% rate for 2021, but now they're dialing it back to 5%. You can see this green number or whatever, orange, I'm not quite sure what color it is, but the blue number is what's been really reported. And then the other number, which is the Atlanta Fed GDP now, you can see what they came into this quarter thinking, it's going to be another 6% quarter. And right now at the end of it, I think it's going to be around about 3.2. So that's definitely a slowdown in growth. And we all know the reasons why. So that's definitely been part of this slowing down story. Inflation, the trend is down. I've just taken these, just updated this from last month, just taken all of these opening categories. So used cars, we know they had a big spike, transportation, gas, lodging, food away, all these industries which were hit hard by lockdown. So when they came back online, we saw these big spikes in inflation, particularly in June, with used cars up 45%. We all knew that wasn't going to continue, but that was the rental cars who'd pretty much sold their entire fleet coming back and having to rebuy it. Gasoline and so on, and car rental prices hit those ridiculous levels of 87%. But you can see where everything's in red basically means that the inflation has trended down, has ameliorated since that peak. And that's what we thought would happen, is that you can't obviously have a car rental market increasing at 87%, on a yearly basis. 5% a month would price that business right out of anybody's ability to pay for anything. So we think that's trending in the right direction. You can see all these numbers are mostly in red, except for the gasoline one. I think here we are. That's obviously high because we're seeing a much more bigger change in energy prices over the last year. But anyway, generally these are all moving in the right direction, which is down. And then again, just to kind of show it in picture form, what we're seeing here is the things like the truck rental one. That's the one which mostly that's a business where prices were flat essentially for over a decade. Your used car was in inflation terms didn't move between 2009 and 2019. Then obviously they collapsed and then they kind of took off, but they'll start to move again. So in most of these cases, we've seen these hook downs, and I think we'll kind of go right back to much more sustainable levels over time. But this is what's going on. Energy is now there are a number of reasons for this. One is sort of just energy and oil prices and effect by supply, and then people coming back with higher demand suddenly and supply is lagging a little bit. But natural gas, it's kind of a weird market, natural gas, because you can't really transport it. They can stick it in special containers on ships, and they kind of look like these big gas containers that go really high, but it's expensive to do that. So, natural gas prices, do tend to be fairly volatile. And you can see, there you go, sort of like a 20-year chart. They zoom around. And they tend to spike in the back end of the year for obvious reasons. But this is what we've seen. We've come from a much depressed environment back here, and we've seen this big price. But the big story is what's happening in Europe. And this is the European natural gas futures market, and this has really accelerated. So again, normally that trades at, this is in euros, and I think it's MWA. I can't remember, like megawatt hours or something like that. But anyway, you can see that again, it's sort of like a 10 to 25 euro swing, and then suddenly, boom, you've got this, and that is partly a result of some natural gas supplies coming through Russia, and there's some problems with that. But a lot of it's to do with the UK problem, where there's a high demand for natural gas on the spot market, and with the EU being out, with the UK being out of EU, they're bidding up natural gas prices. They also can't find enough truckers to get it into the country. So that is at some multi-year highs, and I think it's a supply problem again, as opposed to suddenly everyone's going to be buying lots of natural gas. And it'll depend on the winter side, but certainly for now, there's enough of a concern there that you'd say, well, some parts of inflation, and obviously gas and energy have a fairly big weighting, are under some pressure. So with that, we've seen some spot prices go up, others which I think are ameliorating. But this is the kind of story that inflation for years, the blue one is what the Fed follows, and for years they were sort of just stuck in this 2% range, and now they're looking at essentially it's this one, the 3.6. So you did definitely get your attention here that this is different from what it has been for a long time. I don't think, and the Fed doesn't think either, not really matters, but I mean, I don't think it's going to continue at this level. They'll begin to level off, but it'll probably, and in many ways hopefully, be higher than the 2% inflation that we got stuck at for so long. But you can understand why the headlines are what they are, just because it sticks out a bit like a sore thumb. And this is kind of the next point. It's made treasuries look pretty darn unattractive. This is the 10-year treasury at 1.48%. So this kind of inexorable decline over 30 years, lower and lower, lower every time, you know, it come out of recession. It doesn't seem to get back to the pre-recession levels. And obviously last year was extraordinary. They went down to a record low of about 0.5%, now 1.4%. But look, this is after inflation, and it's, you know, if inflation's temporary, then this will just jump right back up again. But you can see for most of the last 10 years, the 10-year treasury really hasn't got you much of a real rate of return in yields anyway. There's been some capital appreciation that we picked up on in 2020, but otherwise, you know, if you buy 10-year treasury today at 148 and you assume inflation sticks at what it's at right now, you're going to lose 2.68% of your buying power every year. So that doesn't make the treasury and the bond market particularly attractive, which is probably what we've been saying for a while. So the Fed has started to think about tightening, and this is the famous dot plots. I've highlighted what they did for 2023. It's difficult to read, but essentially what they do is they ask all the 17, sometimes it's 18 federal open market committee members, some of whom vote, some who don't, what do you think the federal funds rate will be, you know, 1 year, 2 year, and 3 year out. So in June, you had this cluster of people. Here we go. There were some hawks who thought the federal funds rate will be about 1.5. Most people were clustered around 75 to 1%. A few people who are saying, oh no, it's going to, you know, stick down at 0 for longer. But now you can see it's all been pushed up. So you know, that's the Fed essentially saying, well, you know, maybe the recovery is okay, but I think a little bit more concerned about inflation than they were. And I think there's also some just tiredness of you know, keeping this thing unchanged for so long, and maybe wanting to sort of, you know, ease back, take the foot off the gas on QE. But you can definitely see that, you know, here the Fed funds expectation for 2023 has gone up. The longer run is about the same. So most people are converging to say probably the long-term federal natural Fed funds rate is about 2.5%, which sounds about right to me. But what we'll see over the next year or so is a gradual increase. There's more voting members who kind of feel that way. And just to explain how it works, they're kind of going to do it in 6 steps. So this is step 1. First of all, they say, hey, tapering is coming, and that's what they did last week. They said it's going to come. We're going to announce it in November. So step 1 is done, and then November they'll say we're going to start it straight away, next week, next month, but probably not later than January. Then they'll start the tapering. Then 2 and 3 go together. Then they'll end the tapering. That's probably around August. And then they'll start talking about, you know, that the rates will rise, and they'll talk about the next level going up to 25. They'll do it in 25 increments, 25, 50, 75. Very rarely do they move in 50 basis point increments. They do down sometimes, but very rarely up. And then they'll raise the rate. So this entire process is, so we're here in September 2021. And by the time this starts happening, it's going to be end of 2022. 23. So this is going to be a 12-month process. You'll hear us talk about it, but this will be the next one to watch at in November when they announce the next starting. So that's just how it works. You know, the Fed doesn't come out and hold closed meetings these days and announce they're increasing the Fed funds rate with a surprise. Those days have long gone. So they very much sort of telegraphed the heck out of this thing. And this just showing that some of the logistics problems and supply problems are easing, although as I mentioned earlier, they're still very much part of the economy. Things are not getting through as quickly as they should. You know, if you read about, you know, 60 ships are sitting outside Long Beach, LA docks. If you kind of look on a map one day at the docks in Long Beach, LA, it's through 2 counties. It's miles and miles. It's the biggest port on the West Coast by far. So a lot of all the China trade goes barreling in there. And normally a ship can come in and could be, you know, cleared out in about 10 hours. There's no stories about, you know, ships lining up, having to wait 6 days outside before they're even allowed into the docks. So that there's still that, you know, transportation bottleneck. I think it will ease, demand for freight and everything will ease up a little bit, but there's a container shortage. I've written about this. Containers are in the wrong place. There's empty containers in LA, and not enough full, empty containers in places like Shanghai. And the additional shipping capacity just takes years to come online. You can, put down a ship now, it won't be ready for 3 years. So that's, that's a limit to what can happen on there. And then the other one is air freight, and a lot of air freight is just carried in the hold of regular commercial airlines. So if you go on a flight from LA to Beijing, you can guarantee that the cargo hold is full of not just your luggage, but an awful lot of high value goods. And because with airline volumes being down still, 20% from their peak, that just means there's less freight capacity. Things will begin to ease out a little bit, but they just take a while. Yeah, I mentioned the housing boom. It's kind of over for now. These are kind of the new home sales, so they've come off their peak. This is some of the rush that people had to move house and with low mortgage rates. But the US has a chronic housing shortage. I mean, it's sort of in the 70s and 80s. Essentially, there was a house built for every new person that came into the workforce, and then during the housing shortage, there was one house built for every 1,000 people. So it was a huge shortage. We're about 450 here, so yeah, it's better. But look how compared to having no real pressure on housing, it's still we still don't build enough houses for the increase in the workforce. So that's going to be good for prices. We've seen this incredible increase in prices, and I still think the numbers are. I don't think they're going to continue at 18%. They just well, maybe they can, but I'd be super surprised unless wages catch up. People just push it out to the to be unaffordable. Some of the institutions can step in, sure, and buy them instead and rent them out. But I think some of these house prices, yeah, they're going up because of the general shortage, but I'm not sure they can continue at that rate. With some wage increases, all the wage increases are at the lower end of the market. And it's, the leisure and hospitality trade, the retail trade, they are just seeing some increases in wages. And that's mostly because not everyone's back at work yet. These are, the blue line is all the employees. So it's about 17 million people who were in the leisure and hospitality. Obviously, it very nearly halved in when COVID took hold, and it's back to 15 million. So it's still 2 million short of where it was. And on the local government employees, that's come back. But until those schools fully open up, that number won't get up to its peak either. So the point is that not everyone's back at work yet. And as more people kind of get back to work, I think it'll put some a floor under some of the wage increases. So I'm not particularly concerned about wage increase getting out of hand. And while the wage increases are at 6, 7, 8, the employment cost is still pretty manageable. So these come out quarterly. So we're a little bit behind here with this June numbers, but essentially this says that the cost to an employer, and there's different from wages. I won't explain why, it's complicated why, but really what you want to look at is what's the employment cost for the employer, because that's where it's going to be hitting. And those are, yeah, they're high right now. We've got average hourly earnings increasing at about 4.7%. It's been that high before without leading through to inflation, and it's definitely higher than it was up here, but it's kind of moving in that direction. But again, I don't think it's going to get out of hand. And if you throw the earnings increase over inflation, hey, no one's getting massive pay increase here in real terms, which is what counts. This is a weird spike because it had all the lower wage people falling out of the workforce. But here we are, and it doesn't matter whether it's real average earnings for all employees or for production and non-supervisory. I can throw the weekly one on just to show that, if they're working more or less weeks, this is flat. This is not an environment where you kind of run out and go, oh, I feel, like my wages have gone up, I'm going to go spend a lot. Wages have gone up, but so is inflation. So this doesn't necessarily mean that there's going to be a huge amount of pent up demand. I think the Fed doesn't pay enough attention to this because They're talking about some wage inflation and price inflation and worried about inflation expectations. But I think that the real take-home pay is still pretty meager, because keeping in line maybe with prices if they're lucky, and not as good as it was a couple of years ago. So I don't think it's going to be a massive rush for consumer boom. The job numbers, just look at the blue lines. These are all stacked here. We're slowly getting back. August was horrible. I mean, 235, where 1,000 new jobs, when we were sort of expecting more like 600,000-700,000. We put that down to seasonals and just hope that the September numbers are better. They should be. I don't know if there'll be 1 million, but they should be more like 400,000. If they're not, then this jobs market is going to be, even slower to get back fully on its feet than we thought. The jobs are out there. The blue number is the number of open jobs. So there's roughly 8 million unemployed. That's not underemployed, but officially unemployed. And there's 10 million jobs out there. So the jobs. Now, what tends to happen is that an employer puts out a job opening, said, "I've got a job opening," and then can be very fussy about who they hire. And if they get a skills mismatch or a geographical, mismatch and everything else, then they're just not going to hire. It's going to stay as open. So it's not quite as simple as, well, there's 11 million jobs and there's 8 million unemployed. Why aren't they all going for those jobs? The fit doesn't happen as comfortably as that. But I would say I would take some heart from this, that employers are looking to hire, and that should make the easing back of the jobs market slightly easier. So I generally feel good about the jobs market. It's just taken a while for it to get back fully on its feet. This is as of yesterday. So year to date, small cap stocks up 22%. This leadership has changed a little bit. Back here in June, small caps were roaring far ahead of mid caps, which were far ahead of the large caps. Now they've converged. So between the small caps at 22 and the mid cap at 18, there's really not much. That's not really much in it. That can move in a day. So there's been, it's good to see that the market has been pretty broad, because now you're talking about large and mid, as well as the mega guys, all kind of in pretty good territory. The one that's not been so good, of course, is emerging market. Now, let's just talk about China again. I showed you the houses being exploded, and that's a good example. And some economists have absolutely nailed this. A guy called Michael Pettit has been writing about China for about the last 8 years, and he said this is coming. They're building stuff which is making GDP look great, but it's not economically viable. For example, an airport in Shandong, Shenzhou, or somewhere like that. I'm blanking on but it has a capacity for, I don't know, 1,000 flights a day, and it's only using 50. So that reckoning comes round eventually. It's a bit like the Soviet economy. If you kind of go back at all the missiles and bridges and tractors that they built, and then no one was able to make productive use of them. It's not quite as bad as that, but it's more like that than the US economy, and there is some reckoning to be had. But the central government right now is targeting industries it wants to see succeed. And, there's, I put a few of them down there. And those they view as, and they're going after those that they view as socially responsible. Those the ride-hailing apps, which they know creates an awful lot of labor inequality, and that's the last thing they want to start stirring up. So they put some clampers on Didi. They've also said some rude things about gaming and people wasting their time on social apps and stuff like that. And these companies get the message. They back off very quickly, or they say, okay, well, can we donate, $1 billion here, $1 billion there to some good cause? And the Chinese Communist Party says, yes, that would be a very nice idea. Thank you very much. And so they're still trying to keep some of these parts of the economy sort of in check. And it is a myth that the China needs foreign capital. So when they say that if we buy a Chinese ETF or a Chinese ADR, that capital does not go directly into China. It's just swapping between one owner or another. China doesn't really need FDI, foreign direct domestic. It's foreign direct investment. It doesn't need companies coming over and building $100 million plants. They can do that. They need the intellectual capital, and they need the technological know-how, for sure. And I think some of the industries they're going to be targeting is healthcare. I was talking to a healthcare executive recently who said they were offered some very attractive rates for coming into China. I think if you showed up offering financial services or property development, they would be less inclined to welcome you with open arms. But so they're just looking at industries which they need to develop. They think from a long-term perspective, healthcare for sure, enterprise software, aviation. There's only two aviation big manufacturers in the world, as you know, Airbus and Boeing. The Chinese are coming after that market. And I can't remember the model name, but there's actually some viable aircraft that they can build. And they view that as a huge export earner and as a huge, key economy, key industry. So they're going to be targeting things like that. And obviously semiconductors, because that's 98% of production sitting in one place right now. So they want to be able to have a more diverse economy, and they're targeting it more specifically. On the housing side, as I said, it's overbuilt, over-leveraged, and it's got implications for growth and commodities. Obviously implications for growth, because if you don't need 60 apartment blocks, sitting on the outside of town, then that's going to be, going to show up in your GDP numbers. And if you don't need the 60 apartment blocks, then you don't need the cement and the copper and the iron ore and the all the construction equipment that goes and puts those commodities together to make a building. So that's why, markets like Australia are probably going to get hit pretty hard if this housing market really backs off. We talk about property price inflation here. Look at it in China. Now, the average number, national average, is down here. So, it's kind of the average number. And I apologize for the numbers not being up to date, but the trend's pretty much the same. So this is the annual housing price. So it was renminbi here, down here. It was, I don't know, like 2,500, and over 17 years got to 5,000. Not a big deal, but it's the tier one cities. So that's Beijing, Shanghai, Guangzhou, and Shenzhen. And so, I don't know how much of the population they encompass, but it's a lot. And they're very attractive cities to live in. And obviously that kind of property price inflation is probably unsustainable. And this is what I think the authorities are saying, yikes, we don't want to have too much of this, because this leads to social problems and kind of second-class citizens, two-class citizen problems in all of these cities. And so we want to, try and get this back on track, that it doesn't have this big speculative property bubbles, and we've got 60 million units unoccupied. So I think this is what's in the back of their mind, to try and ameliorate this particular tier one number. Emerging markets, internet have taken a hit. I mean, they're up over the last 5 years, but obviously you can see here, this is the Golden Dragon Index. You can buy an ETF for that, although I would highly recommend you don't. But that's like the NASDAQ for Chinese internet stocks available on the US, and obviously they've been crushed. So that's partly what the government probably didn't mind happening. They don't really care if Tencent goes from 800 billion to 500. They've got other things to think about. So, this emerging markets nowadays is all China. I mean, there's other markets in there, Brazil, Russia, India being obvious ones, but China really swings it. So if you're bullish about emerging markets, you have to be bullish and uncompromisingly bullish about China. And if you're not, which we're not, then you can't really say, yeah, well, I'll be able to pick up some good stories in Brazil and India, because they're just totally swamped by what's going on in China. So, for right now, the emerging market story does not look particularly healthy. At some point, it'll be worth getting back into, but not yet. So, yeah, so thanks for bearing with me. I covered a lot of ground, so I'll just try to summarize here. Delta has peaked. I know we've said that before, but we think it has. It's showing up in the numbers anyway. Consumer activity has been depressed. I think it's going to be slowly coming back. Interesting enough, the national accounts came out for June 30th, and household net worth, exploded up again. I mean, it's much higher. It's at a record high. Now, part of that is because it includes house prices, and also includes stock prices and things like that. But house prices is the big one. So household net worth is incredibly high. And again, that's generally good for consumption and confidence. We've also know that, cash savings are incredibly high. A lot of the benefits from COVID were not spent, but saved. So there's still a lot of that still in the pipeline. It's consumers ready to spend. Hiring has been slow, but it should be steady. I think claims, they're still a little high. They're 350,000 in a normal, going along well. Everything's happy economy. It should be more like 220,000, 250,000. So it's still a little high, but again, expect slow improvement there. Fiscal expansion. I think this, if this infrastructure bill, the one that's passed, is not a big deal. It's I don't know, 800 billion. It's less than $1 trillion, whatever it is. But it's over 10 years. And it's slow project. So it's $80 billion a year on a $22 trillion economy. It's important for political purposes and getting our infrastructure sorted out, but it's not going to be a huge boost to the economy. And it's the same with the other one, which will be a lot less than $3.5 trillion. We still think growth stocks are likely to outperform. Value stocks is really, do you believe in the energy stocks coming back forever? Difficult given what people feel about green and moving away from fossil fuels? Or do you think banks are going to be able to make a lot of money on lending in a spread business in higher rates? Well, they'll make more than they are at lower rates, but I'm not sure that's a great business to be in. So I'd still kind of go out there and say growth stocks are likely to outperform. And then look for the Fed. We'll see. A next big thing will be in November. A lot could happen between now and then. I don't think they're going to change their mind or anything, but that's kind of the next big thing on the rate front, and we're already seeing the market levels move up. So bear with us. I know today was a tough day in the markets, but I think we're only really back where we were 3 or 4 weeks ago, and I'm not concerned about the level of the sell-off. If anyone has Q&A, I hope I haven't sort of tired you all out. We'll make this available if you want to again. Got a question here. What is your reaction to Janet Yellen's announcements of wanting to tax capital gains? I think, well, obviously capital gains are taxed, and I think the issue is, are they going to move up at all? Now, I think they could move up a little bit. I know they're 16 now, they could move to 2021. They're not going to go back to where they were in the mid 80s, where they were the same rate as the income tax rate, which was at that time, I know, 35%. There was a school of thought back then that regardless of the source of the income, capital gains or regular earned income, it should be taxed at the same rate. And that ran for a few years. And then people got tired of that and said, no, we want to help the economy along, and that we want to increase the incentives for entrepreneurs, so we're going to reduce the capital gains tax. I don't think I've got these charts which show that the market's movements in different tax rates has no effect whatsoever. So you can stick corporate tax rates at 35%. They're obviously 21 right now. You could stick income tax rates in at 40%, 50%. 25%, no difference. And I think it's the same with capital gain. I mean, you might see some portfolio shifts around as people say, well, all in all, if I could take a capital gain now rather than risk being taxed at 5 points higher in 2023, and then, some market movement around that. But really, I tend to believe this as, if they get any increase through, it'll be very small. But boy, Republicans have been pretty clear on this. They do not want to, have any kind of tax increases at all. So I'd be surprised if anything gets through. Good. I've got to scam lightly over that. Well, thanks very much. Again, thanks for bearing with us. And if there's any questions, feel free to barrel them in to me, Christian Thwaites, Thwaites at BNJ Advisors, or your financial advisor, of course. And we're kind of open and happy to take your questions, and we'll be loading this up onto the web if you want to hear it again. And a podcast. Please go to the podcast. We like it when people do that. Carolyn, I'm going to turn it over to you to close it if you need to.
Thanks, Christian. Here we're going to play the favorite part of the ending. The disclosure. Everybody misses, I'm sure you're reading it at warp speed, but here we go. Thanks, everyone.
Am I reading it?
This
No,
presentation is for general informational purposes only. References to an individual security should not be construed as a recommendation to buy or sell that security. The securities mentioned in this commentary are only several of the successful as well as unsuccessful investments by us and do not represent all of the securities we have purchased, sold, or recommended. Although we deem reliable the sources of statistical and other information referred to in this commentary, we cannot guarantee the accuracy or completeness of any statements or numerical data. Past performance is no indication of future results. Thank you.